Today I'm going to talk about S corporations that are service businesses and what we mean by a reasonable salary in the context of self-employment tax planning. So I have a previous video that you should check out that is about the benefit of being an S corporation, or why you should be an S corporation. It talks about why advisors will advise S corporations, and the summary of that, for those of you who saw it and to remind you, is that it has to do with minimizing self-employment taxes. But that strategy relies on the idea that you have to pay a reasonable salary for the services provided by an owner within the company, which still, that salary, that amount of profit that is treated as an owner's salary, owner's wages, is still subject to the Social Security and Medicare taxes. So specifically what I want to talk about today is how this might work in the context of a service business, because I see that as particularly tricky when you're trying to come up with a reasonable salary requirement. Let's face it, service providers of various sorts can have a wide variety of wages, a wide variety of incomes. Whether you're an accountant or a lawyer or a dentist, you know, some will make less, some will make a lot more. And so how do we know what a reasonable salary in the service-based context is for the purpose of this kind of tax planning? Well, so technically, you know, when you're looking at the law behind it and the requirements that the IRS has and what they have won on in tax court with, is that the salary must be market-based. So you have to earn a salary. The owner has to be paid a salary that would be similar to what they would make doing a similar job with a similar function for some other firm or company in their industry. And one of the best practices to do in trying to come up with that is, if you already have a process for determining the salary of employees, other employees in your company, you know, you might do some kind of research or some kind of documentation that you put in a file of what you think the market salaries are for other types of employees. Have your team or yourself do the same kind of research on yourself and use the same sort of documentation, so that you can show the process you use to come up with your salary was the same. Your salary as the owner, I mean, is the same as the process that you would use for any other employee, that you're not just making something up to minimize or avoid taxes. This topic about what is a reasonable salary for an S corporation owner, as I mentioned before, this has actually been litigated many times, and so there's not a bright line test for it, but we do have some understanding of how the IRS thinks about it and how the courts think about it when they agree with the IRS. And the IRS will win against a company and its owners. They will win on the subject of an owner not paying themselves a sufficient reasonable salary, trying to underpay self-employment taxes because they were not paying a reasonable salary. The IRS will win on that point when the IRS can demonstrate two things. If they can demonstrate that, first, there is a market rate for the services, and that can be substantiated by recruiting firms that are in your industry or geography. And second, when they can show that the company had sufficient cash flow to pay your market wages. So if they can show both things, then you are you're pretty dead on that point, because that means that's the burden of proof that they have to determine that you weren't paying yourself enough and therefore you were just avoiding self-employment taxes. Now, think about the importance of that second criteria. You don't have to pay yourself wages if your company doesn't make any money, right? But if the company has sufficient cash flow, which is evident when they start making owner distributions in lieu of salary. So if your company is making distributions to you of cash and not calling it salary, then that suggests there was cash to pay you a salary. So you can't be taking cash from the company and then claiming the company didn't have enough money to pay you a salary or to pay the market rate salary, right? There are other facts and circumstances that you should consider. Okay, so beyond the two things that I just talked about, the two kind of ways that the IRS will establish that you should have paid yourself more. The other facts and circumstances to consider, particularly in the service-based context, is what does the evidence about your own business show that your market rate of salary should be. So let me give you a kind of a very simplistic example on one end of the spectrum. Suppose you're a solo management consultant and your income before paying yourself any kind of salary is $50,000. So you're just one person, your company, your S corporation only has you, you're the only employee, and that company makes $50,000 for presumably the services you provide to clients, right? So what should your market wage be in that case? Well, I hate to tell you, but it should be $50,000, right? Because that's the only logic of it. You're deploying your time and services to clients who paid you $50,000. So it's pretty self-evident what the market rate for your time and effort spent in that business was in that kind of context. When that happens, if your profit before paying you a wage was $50,000 and then you pay yourself a wage of $50,000, it goes through the W-2 system, you pay the self-employment, you pay the Social Security and Medicare taxes, which are equivalent to self-employment tax, and then the S corporation deducts that wage that it pays you, there is no remaining S corporation profit. And so you don't have any S corp profit that avoids self-employment tax in that kind of context. So the moral to that story is, if you're a service provider and you are a solopreneur and you only make money from clients by providing your services and you have a fairly modest income, there's not a lot of advantage to switching over to being an S corporation. In fact, in the case that I just provided, there was no advantage to doing that. You just created additional administrative burden in the sense that you have to file a separate S corporation tax return from your own personal 1040. So that would be one end of the spectrum, right? The other end of the spectrum is, let's take a consulting firm, but let's suppose you hire other consultants. You invest in training and process, your fees for other people's time, your employees' time. You charge for your employees' time, and the fees you charge for their time not only pays for their wages, but also includes a profit margin for your company. So consider the economic proposition there's a lot different, right? You're making a profit margin off other people's time. You're not just making money off your own time and your own services. This has a whole different economic feel to it, if you understand that. And so let's say that your business profit before paying the owner is $200,000. And you conclude that a firm of that size and in that industry, in that particular geography, it's on average, the managing partner or the CEO of that particular firm might make somewhere around $150,000 in salary for their services to the firm. So you peg your W-2 wage at $150,000. So remember the numbers: $200,000 in profit before your wage is $150,000. So you take that $150,000 and that goes to the W-2. You pay the Social Security tax on that. You pay the Medicare tax on that, and then the S corporation. Remember, $200,000 in profit before that, $150,000 in your wages. So now there's $50,000 in remaining S corporation profits. That $50,000 in remaining S corporation profits should be distributable to you without self-employment tax, because in that context, it appears that you are earning a profit, a return from your investment in the business, from your investment in building the business. It's not just from the work that you do in the business like any other employee. And so you should be able to avoid or minimize the self-employment tax and not have self-employment tax on that remaining $50,000 in this particular example. These kind of examples, these kind of scenarios are always based on facts and circumstances. So while I say you should be able to do that, I'm not advising that if you fit some of those facts, you should run out and be an S corporation. It really depends on the facts, and the IRS can always disagree with me. And so you always run the risk that the IRS's analysis is different than mine on something like that. I'm just putting out there what I think a reasonable analysis on this would be, and what seems to be in line with the court cases that I've seen where the IRS wins or doesn't win on this topic. And so I think that I think that's a way to think about it. But we always have to caveat this, that these are subjective questions. They're not bright line tests. You can have an evaluation of what a reasonable salary is using the framework that I've just kind of thrown out there for you. The IRS could disagree. You could end up fighting about it anyway. But life's full of risks, right? So, and business is certainly full of risks. So you take risks every day in your business. Dealing with taxes is one of them. So that is what it is. Bottom line, I want the entrepreneurs that I work with to be able to minimize their taxes where appropriate with little risk that they'll be challenged by the IRS. And I think that if you follow the thought process that I put forward here, you will be on track for that. Okay, well that's it for today, or this particular video anyway, and I will see you guys later. Bye now.